There are four arenas where the game of trading is played. Four completely different worlds, each with its own rules, its own players, its own hours, its own personality. Most traders pick one and never fully understand why they picked it. They heard crypto was exciting, or their friend was doing Forex, or they saw someone on social media making money in stocks, and they jumped in without understanding what they were actually stepping into. That ends today, because by the end of this video, you are going to know exactly what each of these four markets is, how each one works mechanically, who is playing in each one, what makes each one dangerous, what makes each one an opportunity, and most importantly, which one fits your specific situation right now. This is not a comparison video where everything sounds equally good. This is the honest breakdown, the one that tells you what the textbooks and the influencers leave out. Video 2 of the Complete Trading series. Let's get into it. Before we go into each market individually, I want to give you one framing idea that will make everything in this video click faster. Every financial market in the world exists for the same fundamental reason. Someone has something and wants to sell it. Someone else wants to buy it. The market is simply the organized place where those two sides find each other and agree on a price. The differences between markets come not from that fundamental idea, which is identical everywhere, but from what is being bought and sold, how large the market is, who the participants are, what hours it operates, and how the price discovery mechanism works. Keep that framework in mind as we go through each one. It will help you see the similarities underneath the surface differences. Market 1, the foreign exchange market, Forex. The foreign exchange market is the largest financial market on the planet. Not the largest by a little, the largest by an enormous margin. The Forex market processes approximately $7 trillion in transactions every single day. To put that number in perspective, the entire United States stock market, one of the largest stock markets in the world, trades roughly $500 billion per day. The Forex market is 14 times larger. It operates continuously from Sunday evening when the Asian session opens to Friday evening when the New York session closes. There is no central exchange, no physical building where trades happen. The Forex market is a global decentralized network of banks, brokers, institutions, and electronic trading systems all connected to each other, trading currencies directly between themselves. This is called an over-the-counter market. The pair always has a base currency, which is the first one listed, and a quote currency, which is the second. You are always expressing the value of the base in terms of the quote. There are three tiers of currency pairs. Major pairs involve the US dollar on one side and the most traded global currencies on the other. EUR/USD, GBP/USD, USD/JPY, USD/CHF, AUD/USD, USD/CAD, NZD/USD. These seven pairs account for the majority of all Forex trading volume. They are the most liquid, they have the tightest spreads, and they are the most predictable in terms of how price behaves because so many participants are watching the same levels at the same time. Minor pairs are pairs between major currencies that do not include the US dollar. EUR/GBP, EUR/JPY, GBP/JPY. These are less liquid than majors but still have significant volume and reasonable spreads. Exotic pairs involve one major currency paired with the currency of a smaller or emerging market economy. USD/TRY, USD/ZAR, EUR/HUF. These pairs have wide spreads, lower liquidity, and can move violently on news events that affect the smaller country. Now here is what most Forex education leaves out. The Forex market is dominated by institutions to a degree that no other market matches. Central banks, commercial banks, hedge funds, and multinational corporations account for the overwhelming majority of Forex volume. When central banks make policy decisions about interest rates, the impact on currency pairs is immediate and enormous. When a large corporation needs to convert billions of dollars of revenue from one currency to another, that conversion itself moves the market. Retail traders in Forex represent a very small percentage of the total volume, and yet retail traders are trading the same pairs at the same prices using the same charts as the institutions that dwarf them. This is both the opportunity and the danger. The opportunity is that the patterns created by institutional behavior are visible on the chart and can be traded. The danger is that retail traders are always the smallest fish in the largest pond in the world. What makes Forex special is the leverage. Forex brokers routinely offer leverage of 50 to 1, 100 to 1, sometimes higher in certain jurisdictions. Leverage means you can control a large position with a small amount of capital. 100 to 1 leverage means that with $1,000, you can control a $100,000 position. That sounds extraordinary until you realize it cuts both ways. If the market moves 1% against your position with 100 to 1 leverage, you have lost your entire account. 1% in a market that moves multiple percent every day. Leverage in Forex is the single biggest reason retail Forex traders lose money, not because they do not understand the market, because they do not understand how quickly leverage amplifies losses. Market 2. The cryptocurrency market. Crypto. The cryptocurrency market is the youngest major financial market in existence. Bitcoin was created in 2009. The broader cryptocurrency market, as most traders know it today, with hundreds of tradable assets, futures markets, derivatives, and institutional participation, is less than 15 years old. It is a market that went from zero to a peak total market capitalization of nearly $3 trillion in just over a decade. Nothing in financial history has grown at that speed. And that growth rate tells you something important about both the opportunity and the risk. What are you trading when you trade crypto? At the most basic level, you are trading digital assets, tokens that exist on blockchain networks. Some of these tokens, like Bitcoin, function primarily as a store of value, a digital alternative to gold in the eyes of many investors. Others, like Ethereum, function as the native currency of a computing network that runs decentralized applications. Others are more speculative, with value driven primarily by community, narrative, and momentum rather than fundamental utility. The range of assets in crypto is enormous, and the quality of those assets varies just as enormously. The crypto market trades 24 hours a day, 7 days a week, 365 days a year. There is no closing bell. There is no weekend. At 3 in the morning on a Sunday, Bitcoin is trading with real volume, real price discovery, and real institutional participation. This never-closing nature is one of crypto's defining characteristics, and it has significant implications for how price moves and how you manage risk. A position you hold over a weekend in crypto is exposed to an entire weekend of global news, social media sentiment, regulatory announcements, and technical developments that can move price dramatically before you can react. The crypto market is the most volatile major financial market in the world. Bitcoin, the largest and most established cryptocurrency, has historically moved more in a single day than some stock markets move in a month. It has declined more than 80% from its peak multiple times in its history and subsequently recovered to make new all-time highs each time. This volatility creates extraordinary opportunities for profit and extraordinary risks of loss, often in the same week. Smaller cryptocurrencies, called altcoins, can be dramatically more volatile than Bitcoin itself. A single tweet from an influential figure, a regulatory announcement from a major government, a technical upgrade on a blockchain network can send an altcoin up or down 30, 40, 50% in hours. This is not an exaggeration. It is the documented reality of trading altcoins. What makes crypto unique compared to all other markets is the transparency of the blockchain. Every transaction that happens on a public blockchain is visible to anyone. The addresses holding the largest amounts of Bitcoin, Ethereum, or any other token are public knowledge. Wallets associated with major exchanges, institutional holders, and known market participants are tracked and analyzed. This creates an entirely new dimension of market analysis called on-chain analysis that simply does not exist in any other market. When a large wallet that has been dormant for years suddenly moves tokens to an exchange, that is visible information. When exchange balances of Bitcoin decline dramatically, that tells you holders are moving their coins to cold storage, reducing the supply available for sale. which has historically preceded price increases. Crypto is the only market where the balance sheet of the market itself is publicly visible in real time. Market 3, the stock market. When most people think about financial markets, they think about the stock market. It is the most culturally embedded financial market in most countries. The nightly news reports stock market indices. Retirement accounts are invested in stocks. The terms bull market and bear market entered popular culture through stock market commentary. The stock market is deeply embedded in the economic fabric of modern society in a way that Forex and crypto simply are not yet. What are you trading when you trade stocks? You are trading ownership. When you buy one share of a company, you own one unit of ownership in that company. If the company has 10 million shares outstanding and you own one, you own 1/10 millionth of the company. You are entitled to a proportional share of the company's assets, earnings, and any dividends it chooses to distribute. The price of that share reflects what the market believes 1/10 millionth of that company is worth right now. And that belief changes constantly as new information emerges about the company's performance, its industry, the broader economy, interest rates, and 1,000 other factors. The stock market operates during specific hours. In the United States, the New York Stock Exchange and the NASDAQ open at 9:30 a.m. Eastern Time and close at 4 p.m. Eastern Time Monday through Friday, excluding public holidays. This is a profound difference from Forex and crypto. When the U.S. stock market closes on Friday afternoon, there is no price discovery for individual U.S. stocks until Monday morning. News that emerges over the weekend, earnings reports, regulatory actions, geopolitical events, cannot be traded until the market opens. This creates gap risk. A stock that closed at $50 on Friday can open at $30 on Monday if bad news emerged over the weekend. There is no opportunity to exit in between. The stock market has one characteristic that separates it fundamentally from every other market in this video. You can buy ownership in specific companies and hold that ownership as those companies grow. A share of a company that grows its revenue, expands its market share, and increases its profits over 10 years will be worth more in 10 years than it is today. This simple relationship between company fundamentals and share price creates an entirely different type of participant in the stock market. The long-term investor who does not care about short-term price fluctuations because they are holding for years or decades. These long-term investors represent enormous amounts of capital parked in stocks through pension funds, index funds, and institutional portfolios. That steady buying pressure from long-term investors is a structural feature of the stock market that does not exist in Forex or crypto in the same way. What makes stocks challenging for retail traders is the information asymmetry. Institutional investors in the stock market employ hundreds of analysts, have access to management teams at the companies they invest in, and process financial information faster and more accurately than any individual retail trader can. When a company releases its quarterly earnings report, institutional algorithms have analyzed the data and traded on it before most retail traders have finished reading the headline. The playing field in stocks is not level, and pretending otherwise is a mistake. Market 4. The commodities market. Commodities are the raw materials and primary agricultural products that form the foundation of the global economy. Gold, silver, crude oil, natural gas, copper, wheat, corn, coffee, cotton. These are not financial instruments created by human agreements. They are physical things that exist in the real world and have value because the world needs them to function. And because they have real physical value, the markets that trade them behave differently from markets that trade purely financial instruments. What are you actually trading when you trade commodities? In most cases, as a retail trader, you are trading futures contracts or contracts for difference that reflect the price of the underlying physical commodity without you actually taking delivery of barrels of oil or metric tons of wheat. The price of a crude oil futures contract reflects the market's current assessment of what crude oil will be worth at a specific future date. That assessment is influenced by current production levels, inventory data, geopolitical stability in oil-producing regions, weather patterns, global economic growth expectations, and decisions made by production organizations like OPEC. Every piece of information that affects the real-world supply and demand for the physical commodity will affect the price of the contract you are trading. What makes commodities fascinating and different is the direct connection between the price and the real world. When a drought hits a major wheat-producing region, wheat prices rise because physical wheat becomes scarcer. When geopolitical tension threatens oil supply from the Middle East, oil prices spike. When industrial demand from China slows, copper prices fall because copper is consumed in manufacturing and construction. Commodities connect financial trading directly to the physical reality of the global economy in a way that no other market does with the same directness. Gold deserves special mention because it behaves differently from other commodities. Gold is not primarily an industrial metal. Gold is primarily a store of value and a safe haven asset. When investors become fearful about economic stability, currency devaluation, or geopolitical risk, they buy gold. When confidence in the financial system is high and other investments are performing well, gold tends to underperform. Gold moves on fear. Understanding this gives you a psychological read on the market that goes beyond chart analysis. Now let's have the honest conversation. Which market is actually right for you? I am going to give you a framework based on 4 variables: capital, time, risk tolerance, and lifestyle. Because the right market is not about which one is theoretically the best. It is about which one you can actually trade given your real situation right now. If you have a small starting capital, less than $5,000, and you want to maximize how far that capital can take you in terms of learning and experience, crypto is the most accessible starting point. It is open 24 hours. It trades in small sizes with no minimum account requirements on many exchanges. You can buy fractions of Bitcoin, and the concepts of market structure, liquidity, and price action that this series teaches apply directly to crypto charts. The risk is the volatility. If you cannot emotionally handle watching your account drop 30% in a week, crypto will break you before it teaches you anything. If you have more capital, between $5,000 and $50,000, and you can commit to trading during specific hours each day, Forex offers a structured environment with deep liquidity and clear institutional mechanics. The major pairs behave well with smart money concepts. London session and New York session provide consistent volume and movement. The danger is the leverage, which most retail brokers offer automatically. Never use maximum leverage. Treat leverage as a tool to be used deliberately and sparingly, not as a free gift from your broker. If you have a longer time horizon and are building wealth rather than income, stocks offer the advantage of directional bias. Over long periods, the stock market in developed economies has historically trended upward. Buying quality companies during corrections and holding them is a strategy that has worked for 100 years. As an active trader rather than investor, stocks require understanding earnings cycles, macroeconomic context, and sector rotation in addition to price action. If you are drawn to macro analysis, to reading the global economic picture and expressing that in your trades, commodities offer a market where your macroeconomic understanding translates directly to price movement. Oil responds to geopolitical events, gold responds to monetary policy. Agricultural commodities respond to weather and crop data. If you enjoy reading the world as much as reading a chart, commodities may suit you in ways the other markets do not. Here is the truth that applies to all 4 markets equally. The mechanics of price movement that this series teaches work in every single one of them. Market structure, liquidity, order blocks, volume analysis, fair value gaps. These are not crypto concepts or Forex concepts. They are market concepts. They work because human psychology is consistent. Fear and greed operate the same way whether the asset being traded is Bitcoin, the euro, Apple stock, or a barrel of crude oil. The patterns created by institutional accumulation, markup, distribution, and markdown appear on every chart in every market because the same mechanics of large order placement and retail participation create them everywhere. What you are learning in this series is not a strategy for one market. You are learning to read markets, all of them. And once you can read markets, you can choose your arena based on what suits your situation, your personality, and your goals. Not based on what someone on social media told you was the best one. Here is the mindset shift from this video. Stop asking which market makes the most money. Start asking which market you can learn most deeply, most consistently, with the capital and time you actually have right now. Mastery of one market is worth more than surface knowledge of four. Pick the arena that fits your real situation. Learn it deeply. The profits follow mastery, not the other way around. In video 3 of this series, we go inside the market itself, away from what you are trading and into who you are trading against, the specific institutional players who dominate every market we just discussed. How they think, how they move, and most importantly, how their predictable behavior creates the opportunities that the rest of this series will teach you to trade. I will see you there. Stay disciplined.